Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Apologize for the late start today for the video. Normally, our Saturday videos come out a little earlier, but we had distracted with some other stuff. Okay, today we're going to talk about an article that came out. The article caught my eye because of the headline. Basically, 2023, it led you to believe 2023 was the worst year ever for real estate.
And it was.
And I'm sure people will now go out when they say, what do you think about last year? They'll say, it was the worst year ever. God, it was the worst year ever. Okay, this is the headline of the article. Mm-hmm. December home sales slump to close out worst year since 1995. Right. The absolute worst year. If you owned a home, you got crushed. It was the worst year to own a home.
No.
Okay. Here is the key points from the article. Okay. Now, it still doesn't mention the magic thing in here, but we're going to talk about it. Key points from the article. Okay. December home sales were 6.2% lower than the same month the year earlier.
Okay, so that is not in price, but in the number of homes sold.
Yeah. Okay. Inventory fell 11.5% from November to December. So the number of, what does inventory mean?
Number of homes available for sale.
Number of homes available for sale, right? But they're using all these negative words. Mm-hmm. Fell, down. Full year home sales for 2023 came in at 4.09 million units. The lowest tally since 1990. This is another negative word, lowest. Since 1995, okay?
Right, so what that means is that this is the lowest number of home sales having nothing to do with value. Again, nothing to do with value, just number of units sold since 1995. Now, we can all agree that 1995 was, like day before yesterday. It wasn't quite that recent, right? And what has happened to the U.S. population since 1995? Well, it's increased
substantially.
By, quite a bit. 40
million people, probably?
Right.
Or more. No, 1995 was 28 years ago.
Right.
Yeah, probably 40 million people. Mm-hmm. So what's interesting here is if 2023 had been the most sales ever in a year, like the most number of homes sold, like 6.5 million homes sold, but home prices were down 10%, all they would talk about was how home prices were down. They would never talk about it was the record year for most sales, the highest number. They would use these negative terms. Okay, so what we're going to do is we're going to go through the article a little bit, talk about some high points. I've got a couple of cool charts that will point out some interesting statistics that will give you insight so that when you're hanging out with your buddies and they decide to talk about something extremely fun and interesting like real estate, you'll have all this knowledge.
So we are going to give you the ammunition for trash talking.
So, you'll be trash talking.
There you go.
When you accidentally run into the crash bros and housing doomers. Okay, here is a quote from the article. The latest month's sales look to be the bottom before inevitably turning higher in the new year, said Lawrence Yun, NAR's chief economist, in a release. Mortgage rates are meaningfully lower compared to just 2 months ago, and more inventory is expected to appear on the market in upcoming months. So we do know that the interest rates are down substantially. Mm-hmm. They were almost 8% 2 months ago, and 6.62, I think, is the kind of the recent sort of where they are. What I think is going to be interesting, Juana, next year there will be zero articles talking about how home sales are higher than they were, because if that was the lowest, and it's predicted by pretty much everybody, more homes will transact this year.
Right.
But there won't be, like, the crash bros and doomers won't be talking about how home sales are increasing.
Well, that's not their audience.
That's not their audience.
Yes.
Right. Do you think, like, mortgage rates really, we're going to show some charts here in a minute that's going to point this out. There's really not a direct correlation between how many homes sell in a year and what mortgage rates do.
No, they're not related.
They're not related. Matter of fact, why don't we do this? I'm going to jump over right now to the two charts that show this, okay? Let's talk about this correlation between interest rates and home sales. Okay, this is the first chart. This is Fred, Federal Reserve.
I thought it was our neighbor.
It's not our neighbor, Fred. This information comes from Freddie Mac. Now, this is the 30-year fixed rate mortgage. This was between 1990 and 1999, which are called the 90s. You were here in the U.S. in the 90s.
I was, and I was a home buyer. I bought multiple homes in the 90s.
I did too. This was your first full decade in the
Yes,
U.S.
that's correct.
This was your first full decade as an American, taking advantage of the American dream, buying houses and making a ton of money. Now, what's interesting about this chart, now remember, look at this chart. Interest rates appear to be very volatile in this chart. But remember, 1995 was the year that was the lowest home sales. But look what interest rates were in 1995. They were 9%. As a matter of fact, nowhere in the 90s, not one place in the 90s, were interest rates lower than they are today, 6.6%. The lowest they are on this chart is that 6.83. They're about 6.8% the lowest they ever were in the 90s. Basically, either the very end of the 90s or probably at some point in 1993, they just dipped below 7%, a 30-year fixed. If you go all the way back to the early 90s, they were 10. If you go back to the early 80s, they were in the high teens. Okay, now I want you all to look at this chart and remember, if I had showed you this chart and said, what were home prices doing? You'd probably think, oh, they were all over the place because they would go down when interest rates went up and then they would go up when interest rates went down, right? Now, I'm going to show you home prices during this exact same time period, okay? Here we go. Juana, this does not look at all like there's been any effect. Interest rates have had significant effect on home prices. Now the chart's a little misleading because the bottom of it is 75 and the top is like 100. So it looks like prices have 10x in value. But in a decade, they only went from basically 75,000, and this is an index, so it's not. They went up about 25%. Actually went up about 33%. Maybe 33% in a decade. But you can see here, they very smoothly went up.
Right.
They were not drastically affected. Let me put this chart back up here. This is interest rates. I should put these side by side. I should make a chart where they're side by side. This is interest rates. Yes, they were tending to fall over the course of the decade because we just had interest rates in the teens, right? But look at the spike here. I mean, in 93, you had rates just barely below 7, still above what they are today. And then a year later, they jumped up. They were above 9%, right? And in that year, 94, 95, if you go to this chart, home prices went up. Imagine that. Well, that's not supposed to happen. We were told that, remember, we were told the 6% rates would cause 40 to 50% home prices to decline. 40 to 50% because rates doubled. And instead, they went up.
Right. So home prices didn't follow that model, but the number of transactions did. The number of transactions did decline because sellers didn't want to put their homes on the market. It wasn't because buyers wouldn't buy. It's because sellers didn't want to put their homes on the market.
Yeah, exactly. Okay, here's a quote for the article. Inventory fell 11.5% for November to December, but was up 4.2% from December 2022. There were 1 million homes for sale at the end of December, making for a 3.2 month supply at the current sales pace. A 6-month supply is considered balanced between buyer and seller. Juana, what really blows me away about this number? Remember, this is the lowest number of sales in 28 years. The lowest numbers. If I had said we will have the lowest number of sales in 28 years, and asked an average person if a 6-month supply of homes is normal, and we have the lowest number of sales we ever had, you would think the homes would be piling up. And how many homes how many months would it take to sell all the homes? What number do you think they would probably say? How many months?
Well, using that logic, I mean, maybe a year, maybe longer.
Yeah. It would be, probably 8, 9, 10 months, a year worth of sales. 3.2 months. We have the lowest number of sales, and we have literally and even if it's the lowest number of sales that we have, we would sell all the homes in 3.2 months.
Right. So this is a number of transactions, not Nothing having to do with price.
No. This, we've said many times before. Interest rates, yes, they affect affordability, but they do not affect price. So price is the where supply and demand meet.
Mm-hmm. Right.
Supply, this 3.2 month supply is shortage.
Mm-hmm.
Shortage, Juana, using your near PhD in economics. Does shortage cause prices to go up or down? Up. That's why home prices went up 6% in Vegas. Vegas was one of the top markets. We have a video we're going to do. We're getting all the data for tomorrow. We're going to show the forecast for the next year and the top 10 markets for price appreciation. Guess which market is in that top 10?
Vegas.
Vegas is in the top 10. Okay, here's another quote for the article. Tight supply continues to reheat home prices. This is the first time in the article they talked about home prices. This is the first time actually in the article anything positive happened. This is like way down.
Well, but I think reheat, well, we won't get into that, but I don't think it has a positive connotation.
Right. When you think of reheat, you think of like the lasagna that you brought home from the restaurant, and then like 2 days later you reheated it. Okay. The median price of a home sold in December was $382,600, an increase of 4.4% from December 2020. Like, you would think this is important data that they should have led off. Remember the key points we showed you? Mm-hmm. You would think that would have been one of the key points. Despite the lowest number of sales in 20 years, home prices were up 4.4%. Mm-hmm. I'll finish reading it. That is the 6th consecutive month of year-over-year price gains. We were told that wasn't going to happen. The median price for the full year was $389,800, a record high, the highest ever. This is the record high for December, mm-hmm. for any December ever. The highest ever, not mentioned anywhere until you dig down in the article. This is like one of those things where the New York Times will post a super negative article, and then they'll print then they'll intentionally put a lot of fake data in there, and then they'll go on like page 37 of like the next week's edition and stick a little retraction in there that no one will ever read, saying, oh, we lied about all this information. Here's the actual information that was saying. So Wanda, where does this, there's more stuff. No, that was actually the last quote for the article. Where does that leave us going into this year? Let's talk about all the records that we've hit, because mm-hmm. we've hit a ton of records in December. Mm-hmm. Lowest number of sales in a year since 95.
So lowest number of transactions.
Number of homes transacted.
Right.
As we go below 95, it's a lower number because this country was smaller.
Right.
Like if you go back to the Great Depression, there weren't that many people. Mm-hmm. We had a third of the population, right? We had the
highest December.
The highest December ever, and the highest number of prices ever. And also this 3.2 months is probably around the lowest amount of inventory.
Right.
So if lowest inventory, lowest sales, highest prices, mm-hmm. what does this look like going into the spring here, the spring season?
So the spring season is going to be kind of interesting. Like I said before, I think you're going to have more sellers coming on the market. I think there's going to be more choice, more inventory. I think there's going to be a flurry of activity, lots of transactions. And this is all with the Fed not having done anything to interest rates, just the interest rates moderating of their own accord as in anticipation of Fed action. We'll put it that way, in anticipation of Fed action. And I think that that's an important thing to keep in mind. I think the anticipation of Fed action is a little optimistic. I think it's going to be closer to what I said all of last year, that I don't see the Fed acting before March and probably not until the second quarter. We've had some good economic numbers as far as inflation and some mixed economic numbers as far as unemployment, and then inflation kind of ticked up again. So I think the Fed is going to be very cautious about playing with interest rates. But regardless of that, I think the market's going to find its kind of equilibrium against the Fed rates. Because remember, the mortgage rates were substantially higher against the Fed rates than they should have been, because there was a premium already factored in for all the uncertainty. And I think there's more certainty in the market as far as the direction that the Fed is going to head in. I don't think anybody believes the Fed will increase rates. I think everyone believes the Fed will absolutely lower rates. It's a matter of when, how much, and how many times. So because there's more certainty in the market as far as the direction of interest rates, I think that's why you're seeing this contraction between the Fed rate and the mortgage rates. So that's going to lead, like I said, to a lot more activity in the spring. And I think that may spill over into the summer more than it normally would. But then, by the time we hit midsummer, I think that you're going to see a considerable pullback as we head into the election. And again, we see more turmoil as far as economic outlook because of the uncertainty. And then you're going to see probably the rates just kind of stabilize and not do a whole lot. I don't think the Fed's going to take action after the summer. I think they're going to just kind of take a wait and see attitude.
Here's what one is talking about with regard to interest rates. If the federal funds rate hasn't changed in 6 months, I think the last time they raised it was like August or September of last year. But mortgage rates have changed, and the reason they went up is because there was still uncertainties whether the Fed would continue to raise rates or they would hold rates for a year or whatever. And then the Fed came out in the fall and said, hey, we're done raising rates. We're going to start dropping rates next year. And there's this risk premium that's usually anywhere from 1% to 3%, which is what you pay over the 10-year treasury, which is what the 30-year fix is based on. And that's how much more you pay. That's the risk premium for a rate. So if the 10-year treasury is 5%, there's a lot of risk, then you're going to pay 8%. But what happened was the market and all these mortgage companies and all the lenders all figured out interest rates are dropping. Let's sell as much of this high interest rate stuff as we can because we know rates are going to drop next year. And what happened was with all this less certainty and with competition, the rates started dropping. And that's why mortgage rates went from 8 to like 6.6, which is well over 1%. So here's what's going to happen, I think, this year. There's one of three economic scenarios, macroeconomic. One is, and I'll let you sort of talk about them, the economy stays on a tear. So we still have 3 to 4% inflation. We have the jobs report every month like we had in December, 200,000 new jobs created. Even though there's companies laying off, we have far more jobs created than are layoffs. And the consumer economy stays on a tear. So with that scenario, how does that affect the housing market?
So housing would do well in that scenario because you still have close to full employment. You still have people who feel good about their economic prospects, and you have people who are going to move forward with purchasing homes. Okay,
now let's go to scenario number 2. That's the middle scenario. This is the inflation drops down to 2 to 3%. The economy cools substantially. We're only producing maybe 50,000 new jobs a month. GDP is growing very slowly. We're just kind of creeping along. Maybe the Fed has some very minor, 2 or 3 quarter point rate cuts through the year. How does that affect the housing market next year?
So that's going to give some people pause, right?
Okay.
So if you already own a home, and you were thinking about purchasing a bigger home, a more expensive home, maybe you'll take a wait and see attitude. If you were thinking of no longer being a tenant and being a homeowner, you'll definitely be a little more diligent about putting pencil to paper and see what makes sense for you and maybe have a greater cushion. So I think those are possibilities.
Okay, scenario 3. We wake up in April and the data is terrible, job losses, unemployment starting to go up, no soft landing. The Fed, they're predicting a pretty good recession. The Fed has a meeting and they start slashing rates and they say, we're going to slash rates 6 times this year. Every time we meet, we're going to slash rates. Interest rates are going to tank. We're going to make borrowing super easy to spur the economy because we don't want this thing to keep, inflation drops to 0 basically, maybe even a little deflation. How does that affect the housing market?
Okay, so that's a kind of a funky scenario because you can take both sides of that, right?
Yeah.
You can take the side of everybody's going to go out and buy a house because now you're basically borrowing, you're buying a house with very little cost against inflation because the interest rates are so down. So basically, it's free money, right?
Yeah.
So that's one side of it. The other side of it, the people who are risk averse. Those people are going to, basically hoard what they've got and just kind of hang tight and not do anything. So you're going to have kind of a tale of two markets there. And who's going to benefit in that, I think, is actually the housing market. And here's the reason I think that would be a benefit. Because the people who feel secure in their income and their job and whatever their economic situation is, those people will go ahead and borrow money basically for free and go out and buy a home. Great.
Okay.
And then you'll have the other people who, so this is at the higher price points. So now at the lower price points, it'll take out the FHA buyers because they tend to be more risk averse because they don't have a whole lot of money to play with in the first place. Okay. And investors will have a heyday because now, they don't have to deal with the FHA buyer. They don't have to deal with the owner occupants. They get to play in the sandbox all by themselves, and investors get to scoop up these entry-level homes because investors, again, they're borrowing money cheaply. They understand the economic cycle. And this all benefits really people with a greater understanding of monetary policy, of economy, just a greater education in general. So really who that hurts is the people at the bottom who maybe have less education, less understanding, and less capacity to weather an economic storm.
I think the conventional wisdom and people don't understand is that there's this belief that in a bad economy, nobody can afford to buy a house. Like the economy is so bad, you just can't afford to buy a house, but you can afford to pay rent. Like, how is it that possible? And if interest rates, and let's say that we have 3% of the population lose their jobs, which would be pretty substantial recession.
Sure. Yeah.
Interest rates would definitely drop at least 3, if not 4%. We'd definitely be back in the 3%, sub 4% mortgage rates again.
Possible, yes.
I think we would if the Fed started cutting rates substantially. Sure. And when you have 97% of the current home buyers, because you've lost 3% of them, right, that could now borrow at half or 3% less than what you could borrow at today, I think that's far more people would flood back into housing, not counting. Remember, we just had the worst year ever for the lowest number of sales, which means, in my opinion, we do have a shadow inventory. We have a shadow inventory of buyers. Mm-hmm. Waiting on the sidelines to flood back in the housing market. Because we keep hearing about the shadow inventory. We should do a whole video on that. Because there is no shadow inventory of new homes, no of nothing. They don't exist. It's all myth. It's all made up.
But I agree with you. There is a shadow inventory of buyers because, these are people who, if you will, have economic emotional scarring from this close to 8% interest rates.
Yes.
So when they see interest rates that are half that, they're going to do whatever they need to do in order to purchase homes because they understand now, maybe more than ever, the value of these interest rates because they've seen 8%. And because it's in such close proximity on the timeline, I think everybody understands that. And I think anybody who has been part of this market in the last couple of years gets it and will jump at the first opportunity when interest rates tank to buy something because they understand how valuable that is, how temporary that is, and they're not going to miss it a second time around.
We've had interest rates that start with a 6 or 7 for a year and a half. Mm-hmm. Do you think interest rates starting with a 5 is a psychological barrier, or is it 4, like 4.9% would cause the flood of people back in to start buying houses again?
So I think they both are, but I think at anything that approaches 4 is going to open the floodgates.
Okay. And what happens if we don't have enough inventory?
Well, we don't have enough inventory now.
Okay. Anyway, all right.
So yes, it means that, look, lack of inventory means multiple offers. It means highest and best. It means paying over asking price. It means having to come up with cash. So all those things. But this is not a new thing. We've kind of been living with that since way back when we had 3% interest rates and all the way through, because the inventory has been insufficient to meet the demand.
Perfect.
Okay, so what did you think? Did you like the video? I really like Todd's charts. I praise him for the charts, I know, because he needs positive.
That's why we were late today with the video. I was up all morning making charts.
Right. I do praise him for the charts, but these particular charts, I think, really illustrate the point that we're making today. So please give him a big thumbs up in the comments for the great charts. We appreciate them. That really illustrate the point well. Please leave us comments. We appreciate them. Remember to like the video, subscribe, hit the notification bell, share the video. This is actually a really cool video to share with people because it illustrates that whole point between what prices do versus interest rates, and you can have talking points with your friends as you're hanging out this weekend and having a good time together. So
talking about real estate
there you
with your
go.
friends.
Hope you enjoyed the video, and we'll see you on the next video. Bye.
Bye.